Well, hello, everybody. This is a bit of an unusual time if you're watching us live on Facebook. Normally, we do our market update videos later on in the afternoon, but I am actually traveling to a real estate conference with an economic update. I'm kind of excited about that. And I am heading there in just a few minutes. But this is our Southern California housing market update. My name is Stephen Meade with Domicile Real Estate for people who love houses, which is hopefully you. And this is our update for October 11th, 2022. Just as a reminder, we're a full service real estate brokerage here in Southern California. If you are looking to buy or sell residential real estate in Los Angeles or Orange counties, we would love to help you out with that. So let's go ahead and get started. Before we do, though, I want to set the tone. We've always kind of divided our general statistics of the market into under $1 million and $1 to $2 million. And there's been a couple reasons for that, but the biggest one is that those ends of the market don't always move the same way. And I think especially in a period of flux, which is what we're in right now, right? We've had interest rates moved up kind of another jump, in the last few weeks. And we've been kind of waiting to see what are the results of that. And guess what? The results are uneven depending on what price range you are looking at. So let's go ahead. Let's get started. And let me share with you what we are seeing going on. All right, so I think we're going to go back to the beginning of our little slide deck here. So first thing we're seeing that is kind of interesting to me. You'll notice that normally at this point last year, we were kind of on this gentle down slope of inventory, which is total active listings that sort of right around the end of the year and then starts picking up again. And we started to see that crest and it started to drop. And then it kind of is actually, inventory levels have actually increased in the last 2 weeks for our under $1 million segment. But our $1 to $2 million segment, inventory continues to drop. Isn't that interesting? And what are we seeing and why is that? And I think the real reason for this, as catchy as our title is these are different kinds of buyers, and not just in a socio-demographic sense, but most buyers in this $1 to $2 million range, they are people buying their second home, right? Or their third home. This is not a first-time home buyer purchase. Whereas under $1 million, there is a much greater percentage of first-time homeowners. Why is that important? Well, the biggest reason that's important is that if you are a first-time home buyer, you are coming from a world of rising rent, right? So when interest rates go up, that doesn't necessarily affect you the same way as somebody who might have a house to sell, a home where they are paying an interest rate of 3%. So if you're an upgrade buyer and you have a 3% mortgage, it is a tough pill to swallow to go to a 6% mortgage, to sell your home with a 3% and get a 6% mortgage. And I think what we're seeing on that is that we're really seeing a looser supply of homes. And that's why this market is just, we're just not seeing the level of inventory buildup or increased inventory that we saw. So if you add these things together, right, and we've thought about plotting this, right, this kind of total inventory under $2 million, we've got like maybe around 7,700 units here under $1 million. We've got maybe 3,800 down here. So 7,600 plus 3,700, 8,500, that's like a little over 10,000 units. But look at where we were at this point last year. We were more in that kind of, between 7,500 and 8,000 units. So yes, inventory is absolutely on the market as a whole, probably up about 20 to 25% versus last year in terms of active inventory on the market. But if we look at our new listings, this is kind of interesting to me, right? Is that we've really seen this curve, that number of new listings just totally dropped off in that under 1 million category. Remember, what do under $1 million sellers going to do? Well, they're probably going to go ahead and buy. They're probably not going to make that other purchase that they were thinking about. And our new listings in our $1 to $2 million category, those are also below where they were at last year. And we are well below last year under $1 million category. Tongue twister there. So the point here is that the rate at which new properties are coming on the market is substantially lower than it was last year. This is the one, though, that really kind of tells a bit of a story. If we look at our new escrows, so this is properties that have gone under contract in the last 14 days. Look at where we are versus last year for under $1 million. Now, part of that is because prices did indeed get higher, but look at the shape of this, right? Like gentle, down quite a bit. This kind of, I have a theory on this, right? And I'm going to share this with you. I'm going to go off screen share a little bit. I believe that there is, in fact, a sort of payment ceiling, right? A point at which the market doesn't have a lot of ability to absorb greater increases. And I think we are actually close to that point, or maybe we've exceeded a little bit. It's right around when mortgage rates are around 6.5%, as it turns out. I think this might be a higher number than other people predicted as that ceiling rate. I think we're going to have to see some wage increases or some other things that will let that ceiling climb up to absorb any further interest rate increases. So I think what we're seeing here is a result of hitting that ceiling, especially for these under $1 million buyers. But what I find fascinating is, let's look at the shape of the curve here, though. Yes, it's a little bit more of a downslope in the last 2 weeks, but is it really? This is definitely different behavior in our $1 to $2 million market segment. It is definitely less interest rate sensitive than our under $1 million price segment. Now, if we look at our absorption rates, right, under 1 million, we've actually seen that number get very close to our 1 to 2 million. So if you look over time, for the most part, the $1 to $2 million category has a lower absorption rate most of the time, right? You can see this delta here kind of going through. And when these numbers get together, when they start running together, that means that there is a difference in how these markets are reacting. Now, $1 to $2 million market is not reacting as much to interest rates as our under $1 million market. And then if we look at our closed prices, again, remember this is based on closed data, which is automatically 4 to 6 weeks old. Where are we at? Well, our pricing in our 75th percentile, which is right around 1.25 million, that is going back to middle of February pricing. Looking at our median price here, where are we going back? You'll notice it dropped a bit from this plateau, and it's for the most part been flat. I think you might see a little bit of softness in this category, but if we go back, where are we really hitting at right now? We're probably back to about where we were in March of this year. And then if you look at our entry level 25th percentile, where are we? We're probably back again somewhere around that early March area is where these prices are at, maybe middle of March. So kind of interesting to look at how these markets have retreated in some ways. In this category, and looking at a graph like this, it looks like that 75th percentile might have been a little bit more exuberant, seeing bigger highs at a peak. Now, if we look at our percent still active, that has bumped up a little bit. I am not entirely shocked by this. Again, I think this latest interest rate bump into the sixes for that critical 30-year fixed rate mortgage, I think that has kind of hit a bit of a ceiling in terms of payment. One other little aside real quick, and this is important in a market like Southern California, jumbo rates remain quite a bit lower than conforming rates. And in a market like Southern California, where there are a lot of jumbo loans, that actually really is a good thing for our market. It's probably one of the only times having a jumbo size market is to our benefit. And then if we look at our close to list ratio, this one is kind of interesting to me. For the longest time this year, where were we at? On average, properties were closing for over 102% of list price. Where are we today? Probably at 99.25%. And you'll notice things fell and then it kind of leveled out. This is really kind of a realistic, historic number that we've seen, that between 98 and 100%. That is where our market typically is. And that sort of begs a question. Is this what a normal market looks like? One where, yes, some homes will still get multiple bids because they are particularly desirable, but also this is a market where there are homes that are not as desirable, and those homes will sit on the market, and they represent a unique opportunity for buyers. We're also seeing these days on market counts have gone up a little bit, but all these things point to a market that's normal. It might not seem that way if you have been in the market the last 2 years and you've kind of gotten used to things being a certain way. But really, when I look at these numbers, when I look at these inventory levels, this is a more normal feeling market. Our days on market numbers, I got to add myself, they have gone up here. I mean, it's still under 40 days, folks. This is still really relatively short marketing times in sort of the grand scheme of things. You'll notice, where were we last year? Between 20 and 30 days, between 22 here and maybe 26 days being on the market. Again, I find it interesting that our two price categories have really been running lock and step. Typically, those $1 to $2 million homes take a little longer to sell on average. Not right now. This is my favorite graph. It's our three-way. What do we see happening here, right? You'll notice if you look at this graph, I'm going to focus here on our blue and yellow lines. This is our payment index and our rental index. And again, these were indexed back to June of 2018, and then we track how much they have changed over time. You'll notice that these tend to run pretty much together, and there's almost this delayed response in the rental index, right? This notion that people want to buy, and then as soon as they decide that buying has gotten too expensive, they go back to the rental market. What does it do? It bumps up rental prices. And you'll see there's maybe a month delay, right, between seeing these things happening. If we keep going on this graph, what did you see happening over here? You saw rents sitting at this level. They bumped a little bit, again, after there was a bump in the payments. Then as the payments came down, the rents actually started to come down too. Interesting, how about that? Rents bottomed out a few weeks after payments bottomed out. And then when payments jumped back up, what is happening to the rent numbers? They are going back up. This is what we call a symbiotic system. It means that these variables are interrelated. And the reason for that makes a lot of sense intuitively, and that is, at any given point in time, you have roughly the same number of people in a given geographic area looking for shelter, right? Like, this can change over time, but these changes tend to be more gradual. So if you've got people looking for shelter, when houses or payments are too expensive, what do those people do? They start looking at rentals. When house payments go down, they abandon the rental market and they go back to looking for houses. So these are very interrelated variables. These landlords and home sellers are looking for the same people. They are pulling from the same pool of shelter seekers. And that's why you see this. I actually think we're going to see this gap narrow up a little bit. Either if we see some drops in payments, we'll see this kind of level out, or we're going to see a couple more weeks of rents increasing. One of our clients is purchasing a home and is renting out their current home. They did a rental open house over the weekend and were mobbed with people. So there was a lot of demand for high quality rental housing at the moment. What happens when there's a lot of demand for high quality rental housing? Rents will go up. This is the way it works. And I think we might see these median rents start to get back kind of into this level like where they were over here. Prevailing mortgage rates. Well, we need to adjust our graph. We stopped it at 6% and it has blown through it. I actually have the number. It is 6.68%. Where do we source this data? We actually get this. It is a weekly updated number from Freddie Mac. We do this mainly to chart differences over time rather than the absolute number. If you are a buy out there, I highly urge you to look at alternatives to a Freddie Mac 30-year fix, because I think there are better options for you. A number of our clients are doing 7 and 10-year ARM loans in the jumbo category from the right bank. These can be into the 5s, which obviously is a lot more palatable for most budgets. Well, there you have it. That's what's going on in the market. We hope this is useful. If you are looking to buy or sell residential real estate, or you just have questions about residential real estate in Orange and Los Angeles counties, definitely reach out to us. We would love to help you and work with you. Do not forget to like, subscribe, and hit that notification bell. Questions and comments, as always, we love them. and we'll see you again real soon.